Um, and with that, welcome to the first annual event recording of Enduring Planets and Friends and these community events that we've been doing for now a full year, Dimitri, as amazing as that is.
I'm so
We're so
excited.
pleased today to talk about cash management, among other things, with all things working capital. I feel like this was such a great session to do because we do not have to explain the importance of cash management to the founders in this room. I think they all intellectually understand the necessity there. But we have some amazing speakers to help us elucidate tools for doing so, the options for extending cash runway with various tools, and then how you make crunch time decisions when things get tough. You know us, we'll keep it candid and tactical. But with that, I'm going to have three of our panelists start with,
Before you do that, I just want
wait,
to I want to give a broader introduction to the series a little bit. So for folks
yeah,
who have
please.
never joined us before, we do these events every month, and our goal is to make sure that all of you are as informed as you possibly can be on sort of the financial topics that matter for entrepreneurs and climate. Um, a few like housekeeping tips. So we are very, very mindful of the chat. So please jump in as things come up, ask your questions. We're not just going to like mindlessly run through a panel here. We want your engagement. If something's confusing, if something's unclear, if somebody uses an acronym, somebody says EBITDA and you're like, I don't know what EBITDA means, please chime in. We're happy to translate for you. Um, as Hannah mentioned, it's recorded. We will also draft some insights, kind of like summary notes of the event after. It will take us usually however long it takes us, but they will go up and they will be shared with you. We also do in-person events. There will be one at SF Climate Week. There was just one at New York Climate Week. We will explore other ones as well. And maybe last but not least, we would love your suggestions on new topics. So as you're listening today, if things come up for you where you're like, oh man, next time you guys do one of these, I'd love to learn about carbon offtakes or bridge financing or whatever the topic is, chime in, let us know. You can also subscribe to the event series through the Luma link. And with that, I think, Hannah, is that all the housekeeping that we need to do? I think if I
Yeah,
covered everything.
great.
Great. Okay, cool. Well, then let's do intros.
With that, let's have Jeremiah start, then Will, and then Dimitri.
Sure thing. Hi, everyone. My name is Jeremiah. I work for a company called Sunstone Credit. Sunstone Credit is a Series B company that does solar energy financing among small commercial businesses. We've been operating for about 4 years. At Sunstone, what I do here is that I run all the capital markets and finance operations, right? I'm so happy to talk about, how we think about cash, how we've been managing cash these couple of years through the tough times that solar has seen, and happy to be part of this discussion today.
Thanks, Jeremiah. Hi, everyone. My name is Will Turner. I work for HSBC in New York. HSBC is one of the largest global banking organizations. But importantly for this conversation, I'm part of a 1,000-person team that purely look after venture-backed tech and healthcare companies scaling from the US and globally. My role, if we think about a bank in two balance sheets, we lend money and we look after money and help move money. So for me, I own and support the deposit accounts, liquidity, cash flow tools, cards, and other elements. I'm really, really pleased to be joining you all today. Look forward to the questions. To Dimitri's point, super open, ask me and others anything. Really happy to make this a good use of time for everybody.
Awesome. Okay, I'll give my quick intro. Sam, I think, is running a little behind our fourth analyst, but we can let him introduce himself when he joins. Oh, wait. While he's joining. So I am Dimitri Gershenson. I'm the co-founder and CEO of Enduring Planet. We are a lender and financial advisory firm in the climate space. So we provide working capital financing to climate entrepreneurs who are trying to navigate cash flow challenges. But also we serve as, I'd call like a fractional CFO or FinOps firm for climate companies. We have over 50 clients in this space, and we handle everything from accounting to modeling to dashboards to cash flow planning. Very relevant for this conversation. And I'll turn it over to Sam for the final speaker intro. Just in time, Sam.
Wow, sorry I'm running a little late this morning. Lots going on. Hi, I'm Sam Kalish, founder and CEO of a company called Copper. We put batteries inside residential appliances in order to make them perform better, make them easier to install, and at the end of the day, build a very large virtual power plant with them. That's a capital intensive business. So maybe maybe we've learned some things along the way about managing cash.
Definitely have some wisdom to share, as does everyone on this call. I hope the audience is picking up that you've got kind of a full spectrum of folks, from founders to lenders who are also fintech platforms themselves, as well as the banking solutions. And so super robust discussion today that we should dive right into. Dimitri, I'm going to come pick on you first about a little bit of what good metrics and dashboards you encourage founders, maybe your CFO clients, to use as the tools for day-to-day money and cash control. Like, how do founders know what they've got and where it's going?
Yeah, so I think obviously tools like this are very business specific. And one of the things that maybe I'll just call out is that we've seen a lot of folks resort to like newfangled, sexy AI products to do this, which often aren't actually well suited for your specific business. I think if you're in SaaS and you have pretty simple revenue like collection processes, they might work for you. But if you're in hardware or project development, or you have hybrid revenue, different kind of AR models, you're going to have a hard time. But generally, we look at this. There's also, I think, a component of timing, right? So if you are a venture-backed company and you just raised a big round, you should still be really mindful of runway, cash, how you're performing to targets, but it's less urgent than if you're a venture-backed company in your last 6 months of runway or last 3 months of runway, or your cash flowing business, which has not a significant cash cushion, and you have to be really mindful of when and how you spend. And so I would say for most of our clients, the things that we're tracking on a weekly or monthly basis is obviously your cash on hand, your net burn for that time period, your top 10 expenses, how all of those things are tracking to performance. So you need to have first a starting model to understand what the future looks like. And then as you hit those time points, you need to reflect on that model and look at your variance according to that plan. And that's really important because as you are, let's say you're a cash burning business, if your prediction in the past was that you would perform like X and you're actually performing like Y, understanding the drivers of that performance becomes really important. So you can make adjustments, right? Because in some cases, you can't make changes, right? Like let's say you have an executive who works for you whose comp is fixed, right? Unless that person is willing to go and take reduced comp so you can extend your runway, like that is a fixed expense unless you lay them off or terminate them. But in other cases, you might be able to shift spending on inventory, on equipment. You might be able to make adjustments that then extend that cash runway and allow you to hit certain metrics. Maybe I'll pause there and then we can dive into deeper stuff later.
I think that's an important one because it really touches close to like other drivers of the business. Sam, maybe you could answer something similarly. Like, what are the metrics you're watching on a weekly or even daily basis for the business?
Yeah, I mean, I think it's nothing. It's not rocket science. It's cash in, it's cash out, it's P&Ls. It's I think I would say at the end of the runway that you may have, you're trying to raise your next round. You're sort of trying to preserve runway for as long as possible. That's, as Dimitri says, that's where it's become really critical, and that's where you're going to spend all your time, all day looking at it. And there's a bunch more stuff to look at. And so, like, how aggressively are we kind of asking our vendors, our customers, our friends to extend terms to us? How carefully are we monitoring those relationships such that we're not making asks that people, we're not sacrificing a business relationship in order to preserve a little cash an extra month or two. And then exactly also, as Dimitri said, is like, okay, at the end of the day, you've got your internal sources of burn to look at as well. And I think, there's lots of tricks you can play in financing and stuff, but at the end of the day, burn reduction, just like cut and dry. It's like, look really hard at where you're spending money and could you not spend that money? And I think what I've seen in my company and other companies, it's just like there's actually a lot to squeeze there in general. You will pay for it in terms of operational efficiency. You'll get rid of some nice to haves. You'll have to hustle and tighten the belt a little bit, but there's usually a lot to squeeze there.
Yeah.
Yeah, maybe the one thing I'll say is that you might be taking away the message that you don't need to worry about cash management until you're at the point where you're close to running out of money. Should not be the message here, right? Like these are things you still monitor, you still track. And one of the things that we like to do every month is look at, okay, well, has our runway gotten longer because of this month's performance, or has it gotten shorter? And if it has gotten shorter, are there things we should start to do now to bring it back to what we expected? Because that's often the challenge, is that companies will say, oh, we just raised $10 million. We've got 15 months of runway. And then like 2 months later, they don't have 13 months of runway. They have 8. And that's like a big problem.
That's like the how your model gets updated is as important as what your model says. Is that what you're saying, Dimitri? I agree with that 100%.
Yes.
Amazing. So the temporal difference between I have a lot of cash in the bank and I'm about to have low cash in the bank is you should be monitoring cash in approximately the same way. And you should set up the systems and the processes that do that, whether that's a weekly check-in or like a monthly burn, overexposure, underexposure. I really like that as a key takeaway. Will, in the banking side, and for some of the clients you work with, how would you categorize good cash management beyond some of the tips we just talked about? And how has that been changing as fundraising overall has gotten harder?
Yeah, thanks for the question. So firstly, recognize that it is difficult to raise at the moment. And as many of you on the call can remember and appreciate, being a founder is lonely. And therefore, conversations like this and the networks are so valuable and important. For me, I'm really lucky. I see about 1,000 customers in our portfolio, from seed right the way through to companies that have gone through an event such as an IPO, both in the US and then around the world. So for me, I still see founders seeking that stability and predictability. I think events from 2023 still linger with a lot of people, where the regional banking crisis caused a lot of uncertainty. So we're still seeing founders and backers really employ a thoughtful strategy around working with a bank. And sometimes that means not a fintech provider that may look like a bank, but is actually relying on other institutions behind the scene to be the bank rails. So something for everyone to think about is your money actually with a bank, or is it with a digital front end that's relying on someone else? Because you've actually got some counterparty risk there. And then there's 3 themes. I think the first is that we're seeing and recommend to the companies we work with to have multiple banking providers. And that might be somewhat ironic, because some people would like to look after everyone's cash. But I think if a couple of years ago taught founders anything, it's having 2 providers that if there is an incident or a challenge, it could be a cloud hosting provider taking down a bank channel on a Monday morning, or could be a banking incident. Having 2 providers there as a primary and a secondary bank is very, very prudent. Perhaps have a digital front end from a fintech and then a bank alongside it, and you've got that flexibility to move money when you need to. Second, I think I see ambitious founders look beyond sort of a digital front end, what you see on a daily basis. And actually, from the banking relationships and cash management, have you got someone you can call? Because actually, whether you're just about to close that round or you're in your last 6 months, speaking to a bank and others earlier in that cycle, I think just really helps the thought leadership. And then the final bit is that all of this and what we've heard from everybody so far is even better if it's actually wrapped up in a very clear treasury policy. And if anyone wants to email me afterwards, I can share a sample. A lot of the VC backers provide these on the internet. But actually having that earliest conversation from your first equity check, your first fund round, when we've raised money and we've given away a part of the business for that, what are we comfortable with? Do we want exposure to certain banks, certain jurisdictions? Do we want exposure to crypto? Documenting that and getting the board and the founders and any investors to bless that just helps that uncertainty down the line. So just 3 things that we're seeing at the moment that are probably more prevalent now than they may have been 3 or 4 years ago.
Super interesting. You're saying that like a founder managing, call it $10 million in cash from recent fundraising or what is the threshold for having a treasury policy where you're actually working with your bank to make sure you understand how that money is exposed?
I've seen it at $500,000 round just
Wow.
as much as a $50 million round. And even if it's just a one pager that says, when we raise money, we're going to use a bank, not a fintech, and that's how we're going to govern it. It just is a good sort of operating practice for when that next round comes through. What I would
Mm.
say is it's prudent to refresh that at least once a year. It takes half an hour. Have a chat with your bank, have a chat with a provider. Are we missing anything here? So that's just
Bonsoir.
an initial thought. We're seeing
Est-ce
no
que je
problem.
peux renouveler mon abonnement ici?
One
Parfait.
second, guys, I'll mute.
No worries. Good opportunity for us to take to encourage everyone to drop questions in the chat if they have them. But sorry, Will, if you wanted to finish that thought.
It was just to say never too soon, just to get an understanding
Yeah.
and an appreciation, take the guidance. And ultimately here, if you're confidently scaling and building a business, it's just as important as if you're scrambling during a crisis to just have that agreed as a framework to build from for cash management.
Yeah.
I think one thing I just want to add here is that, and maybe this is like, I don't know, Will, if I'm going against your guidance around fintechs, but a lot of modern banks have really easy systems to allow for automated transfers and rules within your cash. And one of the things that we often recommend to folks, and we do ourselves, is that we maintain the bare minimum cash in our checking accounts at any given time. And everything else is either in treasuries or in savings. And there's like automated transfer rules that allow us to minimize the amount of headache required. And, like you may not think that like an extra grand of interest income is worth it to you, but honestly, like it adds up. And there's so many simple tools now to handle these processes. So just a thought.
No, I think we're saying the same thing. And without naming a unicorn I used to look after, they had a couple of $100 million sitting in a checking account with me, not earning any yield. And as much as I spoke to the CFO and said, if you move this and it would take 15 minutes into a savings account, it would cover payroll for a year. I heard back, I kid you not, I'm too busy. I don't have time for it. I'm like, you could fund payroll from doing this and doing it smart. So I agree. It's wise to have a diversification. Maybe it's 1 or 2 months that sit in like an operating account, perhaps not driving yield, but then look at an FDIC sweep protection where you get more than $250,000 of protection or some sort of asset management. And I'm happy to talk on that a bit later. So Dimitri, I absolutely agree. Drive that yield, but it doesn't mean you can't have two banks to perhaps play off against each other. Not a bad idea.
Super helpful. Jeremiah, the Sunstone business is slightly more complex given all of the things that you're managing. You've raised capital. You said you're a Series B stage company. You're making the loans, and so your customers also have various cash management needs that you may or may not be monitoring. How are you kind of managing internally your own forecasting discipline, some of the visibility across different treasury strategies within the portfolio of your customers, but also the business itself of Sunstone? Maybe help elucidate the business to this audience and share some examples there.
Yeah, absolutely. And I want to echo very quickly because I think it super resonated what Will said and what Dimitri said about making sure that the cash you raise is actually earning interest income. I actually like I'm shocked that that needs to be said, and I think it's like a very, very big part of managing our cash burn, right? Like in a way, it's almost like you can see the effect, right? As your cash diminishes, assuming you're not like a cash flow positive company, as your cash flow diminishes, this interest income thing diminishes too, and it affects your cash burn. And so you start like realizing what an important part of your cash flow management tool it is. So like definitely echo that. Something I'll say is that yes, I think Hannah, as you said, the way Sunstone makes money is that we get paid a fee on every loan that we issue, right? And so one thing we do is that we approve the loan beforehand, and construction happens on a solar project, and we only clip the fee at the end of 6 months, 9 months, depending on when the project completes. In between that time, in the intervening time, you have to make payroll, you have to all these costs, they kind of stack up, and you kind of manage you manage your current cash flow against like future benefits. Something that's very interesting is that you could imagine that, say, like this month Sunstone like quadruples volume. It might not matter because you only see that cash in 6 months, right? And so like now you have to figure out like how is that worth something? Are you able to like finance that stream? The short answer is like not always, right? Not always efficiently. And so like I think something I wanted to like really, I feel like something that we've seen a lot in our last few years of operations, is that, and to Dimitri's point of, hey, like when you first raise the money, you focus less, you think less about cash burn, and then 4 years later, when when your runway is shorter, you think more about cash burn. Um, I want to say that a lot of the cash burn issues start in that first 2 months when you've raised the money. The one thing I think, and we're all like smaller companies. I feel like the single largest item in all of our, and tell me if I'm wrong, but more often the single largest item is salaries and benefits, right? And like you wouldn't believe the types of hiring and bringing people on in the first month or two that actually like really causes you to have a runway problems later on in the life of the company, or to make tough decisions, like heartbreaking decisions later on. I super encourage taking a very hard look at every new employee you bring in right after a capital raise. I recommend trying to, if you, depending on how you view equity, trying to make sure that as you raise your first tranche of equity, how much equity can you use to compensate new employees, and try and use that as much as you can to create alignment between employees and the company. Don't be afraid to have like try to like push vesting periods. And I know all this sounds like I'm an employee too, right? But like all of this sounds like pretty aggressive things to do to employees. But honestly speaking, like that really, like, if I had taken like an extra like $10,000-$20,000 a year in comp, and instead, like, you asked me to take it in equity, right? That has cash flow implications down the line, when you start looking at your last 6 months. And I would say like one thing, and something I wanted to like talk about with Will, is that something about having multiple banking relationships. Like I definitely understand that, but in some cases, there are many companies nowadays that would allow you to draw venture debt. Now, I don't recommend venture debt for companies that are like younger, right? But for companies that are like slightly older, the value, or the kind of the notional, or the amount of like the quantum of venture debt you're able to draw is directly correlated to the amount of deposits you have with that single institution, right? And so like I guess like in some ways that's a consideration to like having multiple banking institutions service you. I think you should always have like a hedge. You should always know like where, like what happens if this company goes down. Like everyone's like scarred a little bit from SVB, right? But I think that at the same time, diversifying it, if say like you have a really good venture debt relationship with a single bank, there is some benefit to having concentrated relationship with that bank itself. So
So
I'll just say that
I
much.
I want to chime in on that. Some banks have luckily changed the tune of how much of their money, your money, they require to be placed in the account in order to like manage a venture debt line. And sometimes that venture debt line is not tied to the amount of money you have in the bank, but in how much money you raised and you have across all banks. But I think that's a really good point to flag. And this is like something that venture debt's not the topic du jour, but as you're exploring credit products, these types of requirements become really, really important. And I think if the SVB crisis like showed anything, is that borrowing money from a bank that requires you to maintain all of your assets in that same bank can pose undue risk that you may want to avoid.
Jeremiah,
Excellent.
I think it's a great point. I've seen term sheets even recently range from 50 to 85% of the liquidity and the deposits to be with the venture debt issuer. Equally, what I've seen, which has been nice, is when it's not been traditional venture debt providers. So I'm not talking of the SVBs and the HSBCs. There is the ability to offer something to that lender called a DACA, a Deposit Account Control Agreement, quite standard. And effectively, that would protect the lender in that case, saying if there is a default or something that happens, they have the chance to come to the bank and then say, there's a default, can you freeze the account because we're going to go through an incident, and therefore they can recoup that money if it sits there. So if that helps with anyone as you're negotiating, you could offer a DACA to help provide that control. But genuinely, I have some customers that have left with us a month's payroll. That's it. And I'm very happy. And I think many other banks are being that sort of second backup bank, because there may be something in the future that is a future equity raise that creates opportunity. So I don't know if that helps from just a defensive strategy that might help others thinking about multiple banks and how to sort of feed a few mouths, but ultimately get what you need as a founder to make sure you've got the funding, the predictability, the stability, and the visibility that you need.
Awesome. Go ahead, Jeremiah, if you want to jump in on that.
No, I totally agree. And I did something did occur to me as everyone was speaking to is that, back to that first month after you raise, in a way, like the first month after you raise is the strongest like your company will be. Like before the next raise, obviously. And so sometimes if you have like asset heavy businesses, and imagine you enter, I'll just give an example. You enter into a warehouse and you're like, hey, like I have all these like loans that I'm yes, Dimitri, absolutely. Yes, or if you're cash flow positive, then you're like you're like a golden, you're like the holy grail in these eras. But I would say that if the moment you raise your first tranche of equity, and assuming like you're negotiating a warehouse term sheet for like your assets. So say like for us for Sunstone, we issue loans, we can pledge these loans into a warehouse and create an asset-backed facility that the guy making the asset-backed facility, what is a warehouse? A warehouse is a credit facility that allows you to fund assets. And when I say assets, I'm going to use a concrete example, right? So for example, Sunstone issues solar loans, right? These loans, when we fund them, they can be funded by completely equity. So for example, if say I issued $100 of loans, $100 could come from Sunstone's treasury. Now, that's generally a very difficult business model, and you wouldn't want to do that, right? It's very bad use of equity. However, you can go out there and can say like, hey, like credit fund A, you could come into a warehouse with me. I'm going to issue this solar loan. Your loan is going to be backed by the solar, by like, that collateral and whatever that solar loan is worth. But you would only pay 70% of it, and the remaining 30% comes from Sunstone, right? So that sort of structure is what I call a warehouse, or like maybe like a credit facility, right? When I use the word warehouse, it often means that eventually it gets moved into another funding source, right? So like it's almost seasoning in a warehouse, like what a warehouse is supposed to be, before it finds like a permanent home, right? But I think it can be, when I say warehouse, I actually mean that term interchangeably with a credit facility that you would use with a traditional hedge fund. But what I was trying to say is that when you first raise the capital, that's when the credit fund wants to lend to you, because they know you have like runway, and there are definitely covenants around your runway, or like focus on your runway. They don't want to like issue a line of credit to a company they don't know it's a going concern. And so that's kind of when the time, if you feel like you want to have a credit facility, that's kind of the best time to negotiate that. And it doesn't get easier. It just gets harder and harder as your cash burns down to negotiate one of these types of structures, right? Happy to talk about it, right? I actually think that it's in like our I feel like if your sector has it's in say like if you're manufacturing, if you're building things, if you're lending money for folks to build projects, financing that project is a very core part of how you run your business model.
Amazing. Thank you for taking the extra time to help explain to the room how we're using the term warehouse here. And this topic about like what tools you're using, how you manage your treasury relationships when you're thinking about being cash conscious, both just after the raise and before a raise. I want to end with one question to all of you about the use of AI today in the cash management process, and in especially like pro forma modeling and more. Like, how are you using it, if at all? What's working, what's not? What do you see as pros and cons? And then we'll move into creative methods for cash extension. Dimitri, I know you've got a lot to say on the topic, so why don't I come to you for a quick five?
Oh man, I was hoping to go last. I'll just say this. I think a lot of this depends on how complicated your business is and whether or not the product is built for the kind of revenue and expense profile that you have. And I don't just say this because we build financial models and cash flow planning tools for climate companies. I think there's definitely a use case for these products. What we are seeing a lot of in the market is AI-enabled, people-based providers. So like even we at Enduring Planet will use AI in our flow to make the products that we build for customers better. But in the end, you're getting a custom-built thing that is specific to your business. And that matters when you have something as complicated as copper, It matters less when you have something as simple as, oh, we have a consumer software product where people pay a subscription and they prepay us and it happens every month and it's credit card based. Like there's not a lot of complexity in that business. There's a lot more complexity in a business that has to manage inventory, has to think about manufacturing, has to make investments in equipment financing. Like, it's like so much complexity that can go into one of these businesses. And so I think maybe I would say that if you are not an expert in finance, where you can audit the work that is being done for you by an AI product, I would probably avoid them for now until the tools become much more robust. That's just me.
Sam, are you using AI in any of your cash management?
Yeah, I mean, I use AI across my business, but I echo Dimitri's points, like with a 3 exclamation marks, like it's too important to trust an AI to do cash management for my company. Like I'll use an AI to write the Python script that helps me pull all the data I need into the right format for my operating model, talk to my various platforms, things like that. But again, it's always in a form that's auditable and editable by me because I'm standing behind it at the end of the day. So yeah, firm position there.
That point about auditability is something that Dimitri and I have worked on about 3 different mandates together, and I have consistently been coaching founders. Like, if you cannot defend the formulas in pretty much every line, and if you don't know what drives them, that is not auditable. It won't be to your funders, but if it isn't auditable and manageable by you, like that's a failure of cash management and kind of business stewardship overall. All right. Well, unless Will or Jeremiah have any really hot takes about AI tools.
The only bit I'd add, we've been using it for about a decade, 600 deployments, but a shout out to a firm I saw recently called Digits. They're an AI native sort of accounting tool. So there's some things that you'll find in the bank channel, but the Zeros, the QuickBooks, the Digits of the world are bringing an awful lot that you could use to query your own data in the third-party solution you use, just for those sort of coaching tips, just to get more insight from the data that you own, because it's your business and you know who's paid you and who hasn't. The more benefit you can get from some of these tools, it might shape the opinions that Sam and others are making.
Roger. And while Altman is hiring a bunch of ex-bankers to help him build out maybe better tools, and we'll all wait with bated breath to see how they turn out. One thing that AI has been echoed in fractional CFO circles is the use of QA. Like, don't yet let it run the thing for you or make decisions for you, but let it prompt you about what seems inconsistent or what you could go double click into if you want an extra body over your shoulder. Let's talk about ways to extend cash. We've talked a little bit about warehousing and other lines of credits, but that looks very different, versus if you have a collateralizable portfolio of solar loans with like SMBs who are very credit worthy and consistent. Looks also very different if you're, we've talked a little bit about venture debt, and for anyone who wants to know more about that or other corporate-based lending, we have done a series on that in the past, so you can check out our past recordings. But Sam, I want to come to you first on this one about what tools you may have used, not just venture debt, but any receivables or even revenue-based financing metrics, funding sources in Copper's journey.
Yeah, I mean, the way I view these tools as, I've worked really hard to build a company that, sells a product and makes money on selling that product. Imagine that. And I want to leverage that as much as possible to avoid turning equity into inventory and to help my company grow as quickly as possible while maintaining as much equity as possible. So yeah, we explored all these. We leverage venture debt. I'm a fan of venture debt for companies that do have, profitable unit economics. Obviously, need to establish speed limits around that, and there's real dangers in getting over leveraged there. We also have utilized revenue-based financing. I'd say some of these tools have kind of a black eye or like a bad rap, but they've been great tools for us. So things like merchant loans, which definitely, like, there is some predatory stuff happening in that industry, but if you can make a spreadsheet and calculate what it looks like for your company, I found great options here. Helped us extend cash based on the revenues we have coming in.
What's a merchant loan, and how is that different than receivables financing?
Yeah, so the real finance people in the room might have to educate me on the difference between merchant loaners and revenue-based financing. But essentially, your an e-commerce platform could offer you a loan of a fixed amount of capital that you pay back out of your future sales, and because they're have been working with you over a course of a certain amount of history, they're confident that you'll make said sales and are willing to lend.
And how do you,
And I'd say maybe one advantage over um, a more traditional instrument is just they're pretty lightweight. And when you, especially in, we keep talking about immediately post raise or immediately pre raise. In the immediately pre raise time, like lightweight things are valuable. Just because your attention is one of your most valuable commodities at that time, and so it's not to be overlooked, I think.
okay, helpful. Dimitri, do you want to comment a little bit on what you're seeing? I know you offer the grant financing product, but what else you're seeing in receivables financing as that has become more popular? And then when we talk, we'll talk a little bit about strategies and how to, make judgments in this space. But like, how do you help founders, and Sam, you can comment on this as well. How do you know what's predatory? Like, especially when you're in that, attention focused pre-raise time and it is lightweight. How do you avoid getting into something that's going to make your other lenders kind of freak out or prevent you from getting other sources of credit down the line?
Yeah, I mean, I think Sam's point is right, is that in the end, it's your job as a founder to understand your actual cost of capital and your ability to service that cost of capital, right? So I think, for us, there's usually sort of a line in APR terms or IRR terms where we start to think that capital is predatory. And that number probably in today's market is around 25%. And that doesn't mean that like you shouldn't take that money, right? So for example, if you go and try to get a loan from Shopify or Stripe, right, which are like probably two of the largest receivables financing platforms for consumer and also B2B businesses. I mean, they now are floating insane amounts of capital. Depending on the deal structure. So the way that they work is they're basically saying, hey, give us 5%, 10%, 25% of your receipts over the next 9 months until we hit a fixed fee structure. Well, the problem with that is that if you overperform their model, that money could have a 50% cost of capital, it could have a 70% cost of capital.
Yep.
If you dramatically underperform that model, it might be a 20% cost of capital. It's not going to be much cheaper than that because they are very conservative in how they price. And there might be a moment in your business where you have all you need is 2 weeks of cash and you're going to raise your next round or you're going to clear profitability or whatever. And at that point, 50% money might make sense for you if you have no other options. But the key, I think, is to prepare for that moment and not end up in that place. And this is the thing that we often see from entrepreneurs is that they're like, well, I'm going to burn my equity until I'm really close and then I'll raise debt. That's the inverse of what you should do. Your equity is the last thing you should burn, and debt you should take on the moment that you even start thinking about cash flow management, right? And generally the guidance we give to folks is that if you have a predictable outcome, that can be financed with debt. So that could be a durable piece of equipment that you need to buy. You can get equipment financing for it. The predictable outcome there is that the equipment has residual value. It can be resold, right? If you have a sales contract, you're selling to Microsoft and you've done the work before, you know about how long it's going to take. You can factor in some delays. You know when they're going to pay you. That's a great thing to finance. You have a big grant that requires you to spend the money, submit an invoice and a report, wait 90, 120 days for reimbursement, fairly predictable, you can finance them. So at Enduring Planet, we lend against basically any contract. You have a commercial contract, you have a government grant, you have government procurement, we will lend you money and we'll help you navigate that cash flow. And I think the thing that people should really keep in mind is that to Sam's point, like speed, complexity, collateral, covenants, cost of capital are all interconnected and they are, you make trade-offs, right? So the fastest deals are the highest, most expensive. And if it's an MCA loan, not like a Shopify or Stripe loan, like an actual merchant cash advance, those have a lot of teeth when things go wrong, right? With Stripe, arguably, you can move all your payments off of Stripe and never pay them again. They don't really have a lot of teeth, right? You shouldn't do that. They have legal recourse, but functionally they don't have a lot of teeth. But an MCA lender who has an all assets lien, they'll show up at your offices the day you're late, and they will take all your furniture and go sell it on the open market. And so, like, I think you just have to be mindful of those trade-offs and pay attention to how, maybe going 1 week faster costs you an extra percent in IRR or a percent in APR, or has an extra layer of collateral or covenants. And we write about this a lot in our blog series as well, in case people want to check out more.
Just hopping in on the predatory topic. Yeah, I would agree with Dimitri, just a line in the sand on APR, and I think ours is more conservative than yours even. We're not willing to make sacrifices there. And then one other thing to keep in mind in this trade-off space is prepayment. So, if you take a bit of debt over here and you're planning to get a bigger bit of debt over here, make sure you can pay off that small thing when you want to go take the big piece of debt. So that's kind of a line in the sand for us as well, is not having really arduous prepayment penalties. In the multi-axis trade-off space you were mentioning, I would put relationship on there as well, especially when we're considering much longer term vehicles. So, for instance, with a venture debt lender who may want you to move more of your liquidity to them, as we were discussing, like, make sure you have good relationship with them and are confident that you can effectively bank with them, especially if that percentage is high.
Heard. Let's talk a little bit about what some of that, like how to structure that working capital or what it can look like, and then what operational changes founders can maneuver around in order to attract the right structure of capital. Jeremiah, I want to come to you first. You offer products that sit in the project finance stack as well as just general customer credit. So walk us through a little bit more about how Sunstone is structuring working capital lines and their loans, and how are those various structures impacting the underlying customer?
Yeah, I think the best way to think about it is that, when we finance the projects have a construction phase. And so, like, we have a product that finances part of the construction phase, right? And I think the way we think about that is, we first, number one, and I think this is maybe a little bit of like history, is that if you think about a residential solar space, there were actually a few blow-ups around people trying to finance working capital of installers, right? They advanced too much too quickly, and then subsequently, that money, when they had too much concentration to one provider, and when that blew up, that blew up. I think that. And I feel like some of the practices work both ways, right? And look, I'm not, if you're trying to be fraudulent about it, like, do what you will, right? But I would think that you should size all your financing, especially around around like the working capital stuff, around your exact needs, right? So, and that's the same way we finance working capital of our installers, right? So firstly, what do you need day one? Is it permits? Like, if you need to have permits, if we trust you a lot, we can try and finance the permits. Now, it's interesting financing permits, because when you do that, like, if something happens, you don't really have much left, right? You like, the permits, the cost of the permits are gone, kind of. Now, if you want to purchase equipment, right? If you want to purchase, say, like solar panels, modules, inverters, things like that, to build a system, then we can finance against that. But if we want to finance against that, we want to see the invoices to purchase the systems. We want to, if possible, we want to make sure we make the payment directly to the OEM, things like that, right? And so I was going to say, in that situation, the risk is different too, right? Because if, say, you know that the cash was used to purchase the systems, you used to purchase the inverters and the modules. If something happens, you can always go back and take the module and use it to complete the project, in the event of something happening. And then after that, you start getting to what I call, like, the harder things to finance in working capital, right? Which is like, hey, like labor cost, right? All that kind of stuff, the installer margin. And I think at some point, as a financer and as a borrower, you have to figure out, like, hey, like, where's my limit that I want to finance within working capital, right? Like both, and I think as a borrower, like, you don't really have to worry about that too much. But as someone who's financing working capital, everyone has, like, that limit in their mind somewhere, and you'll push up against it sooner or later, right? And I think that, For like project finance type deals, like working capital lines like that are I think they're like fairly common and sometimes really, really necessary in our industry.
Roger that. Will, how does that, like, how does some of that commentary resonate with what you see founders take advantage of? Maybe some of the fintech platforms that maybe clients of yours like Sunstone. Um, how are you, like, how do folks respond to making their own operational changes in order to better receive working capital lines, whether that's, shortening their revenue cycles if they can, doing other means to free up cash internally and to cover things like labor, installation margins, cost, developers costs. Like, how do you see folks pulling levers in order to be suitable for receivables, working capital, venture debt?
I love this question because it's sort of taken me back 18 years ago, day one, when I sat down at HSBC for like credit training. And at the risk of stating the obvious, like cash that you've not received yet is not cash. So as companies think this is coming in, until it's in your bank account, you are going to potentially have a challenge. Let's be realistically, some customers are going to pay you late. Some aren't going to pay you at all. How prepared are you for that to happen? How close are you monitoring your receivables? Are you rewarding through the terms that you offer the customers who have been loyal and paid you on time? Are you treating them in the same way that someone is always 90 days late? So maybe that comes back to some of the AI tools within your treasury management solution, but who is paying you on time? What does that book look like? A couple of thoughts for companies at different stages of the life cycle. Firstly, I've seen a lot of customers use commercial and corporate credit cards. And sometimes the tendency is to think, great, it's a card I can pay for my $6 coffee when I'm in New York or to book my flight to San Francisco. No, it's so much more than that. This is where companies can be putting significant B2B spend on a card and effectively get 45 days of free liquidity. So if you take a charge today for your next cloud hosting bill, your next big sponsorship, and the vendor, your company is prepared to take that on card, you often don't pay the bank back for 30 to 45 days. That's free working capital that you should make the most of. So tip one, think beyond the traditional T&E use for travel and entertainment of where else you could use cards that are typically easier to get. To Jeremiah's point, when you've closed that round and you're in the news, that's when a lot of banks and providers are looking to build that relationship. Take that when you don't need it and have it in the back pocket. Then if I go to some of the perhaps larger businesses, in a prior UK role, I worked in our equipment finance business. So we lent about £4.5 billion from HSBC UK. And I lent against electric London buses. I lent against delivery vehicles for marketplaces. I lent against equipment in a chocolate factory. That was the best site visit I've had in 17 or 18 years, living up to the Willy Wonka vibe. But you may have assets in your business that you've either borrowed to buy the asset or you've paid it off and you've got a chance to borrow against that asset. Dimitri mentioned it, there could be a lien against that. So there could be someone, if you default, comes and takes the equipment off you if you've not met the terms, but look at equipment finance. And then perhaps you some are lucky enough to deal with some of the largest enterprises around the world. There's something called supply chain finance. So it's public information. We do a lot with the likes of Walmart. And there's a case study on the World Economic Forum's website if you'd like to see more that came out in May. But sometimes if you're actually selling to a larger organization, banks offer preferential credit because effectively we as a bank might say, well, my risk isn't actually to a smaller business coming through a growth cycle. It's actually to Walmart or a larger enterprise. So what we do is together, we say, well, actually, we'll offer you cheaper financing with preferential terms because we can see you're dealing with a customer that we value and has a better credit profile than you do. And then the even better thing that happened with the Walmart arrangement is the interest rate that was actually paid was linked to some ESG goals that were put in place. So if you met certain terms, you actually got preferential financing. And for many on this call who are focused in that space, this could be an interesting way. Not everyone here is working with Walmart yet. Some may not want to, but you could look at everything from a corporate card to equipment finance and then to some supply chain finance. And then the final bit, and this might be unexpected, but the surest way to cause cash issues is not to have adequate fraud controls at your company. So we talked about AI. Fraudsters are embracing tools quicker than anyone can actually realize. So for some where there's fractional CFOs and people in businesses, my ask please is to just check that you're comfortable as a founder with the fraud controls you have in the digital channel. Have you set the right access privileges for folks that are looking at accounts and empowered to move money? Have you set up a check block or an ACH block with a bank to make sure someone can't come in and take money? And when you get those invoices, and we've seen them unfortunately in the personal life where I've just changed it comes through, it looks genuine. I've just changed my bank account. Can you now pay my new account over here? And someone has got into that. Just a sort of sensible bit of guidance linked to the topic, not structural, but protect the business from potential fraud as well.
You mean I should pay all the easy pass text messages and click the links I've been getting by phone?
Exactly. Yeah.
Perfect.
Yeah.
Dimitri, you were gonna jump in?
Oh.
Jeremiah,
Yeah.
please.
Yeah.
Go ahead,
for it.
Jeremiah.
I was gonna say just real quick. I think just to echo what Will said, which I think is a very, very key point, is that yeah, definitely if you have a receivable from Walmart, right? That's like a fundament, like that's what we call like a rated counterparty. You can reduce the cost of debt there by like literally 10%, right? So for
Yep.
example, if you have like over here someone said receivable financing is 20%, but if I had like a Walmart receivable, that number is more like 7, right? So you could literally cut like 13% off your cost of funds if you knew that. Now the other thing that I think is like much easier and maybe a lot more relevant to folks on this call is like, hey, like if you're in equipment financing, which I think Will brought up, very, 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 very key, and I almost forgot about that. But if it's equipment financing and it comes from like a good OEM and all that stuff, right? You could finance that at like 10, right? And I'm throwing out numbers here because it's just like how I feel that would cost. Like I wouldn't be surprised if equipment finance, like it's a 7-year term around like 10. And that's like a much more efficient way to finance than sometimes like I think even some venture debt lines that I've been seeing from folks recently.
I I will give anyone $100 if they can come to me and show me a loan at 7% against any contract to a startup. So I might challenge that a little bit.
Like for example, the guys who build like data centers now, right? The contracts are all like PP, like all like from like Meta, Google, those contracts. Like I think like that's why some of the data center like collateral is like very, very efficient. I don't know if it's like 7% to like me, but I think it's
Yeah.
it's 7% to like a bunch of folks. Yeah.
I'm gonna
Dave's ready.
I'm gonna take that challenge, Dimitri.
Okay, bring it. Bring it. I'm happy to buy you dinner when you get that when you get that deal. Um, no, I think on the fraud side, like look, we implement a lot of controls, especially because we're lending money, right? And um I wouldn't say that we have had this situation, but we know peers who are like ready to close financing and they get an email with wire instructions, right? And like even just checking that the email is coming from the right domain is no longer sufficient. And I think that for anything like lots of stuff where it's $10 here, $10 there, like you don't need to call the vendor to confirm. But if you're outlaying a large sum of money, I would recommend a phone call almost always, right? And make sure you're calling them; they're not calling you, because that's like even in today's world, AI can falsify voice. You can falsify a phone number. You can't falsify on receipt though. So when you're calling them, there's no way to fake that. And ideally, throughout your process, you've collected that information in a way that allows you to be secure, right? You're not like in the same email thread being like, "What's your phone number?" and then falling through because you can get in trouble there. Some banks, though, will allow you to like pull money back if it's done fast enough. But just know that if you send a wire and you're more than like 24 hours out, it's going to be pretty tough for you to get that money back unless you're a very large client.
It's definitely not something to joke around with. And like you said, there's a few with a few simple things you can really take that to the next level. But also, a friend of mine in the kind of large infrastructure build out space once was like the cheapest cost of capital that you can fund your business with is first revenue and second supply chain financing. But Will, I don't think he was actually talking about the like receivables against the creditworthiness of your customer. He was actually talking about switching up your payment terms to your own supply chain and vendors and going from things like net 30 to net 90. Because in some cases, and this can also be the company themselves being a bit more predatory, but like if Sam started buying batteries on a different cadence, he's just freed up 60 days of working capital potentially. And that doesn't have the same cost of capital that these other like merchant and revenue based financing would have.
Yeah,
Yeah, you took.
excellent,
Oh,
excellent
go ahead.
guidance. Sorry, excellent guidance. And that's on you as a business on how far you can stretch that, if that's the term that we can use. Yeah, 90 days is brilliant if you're not having to outlay. And then on your inward, if you can offer even sometimes a 5% discount if some customers pay you 30 days earlier, that might be worth it compared to your borrowing cost and the hassle. Sorry, Sam.
No, no, not at all. Yeah, I was just going to roughly echo the same sentiment, which is for any of these decisions around financing facilities or strategies, we try to compare against internal operational things we might do and try to actually compare them on the same metrics. So like go and take that reshuffle of the supply chain and get a dollar figure and an APR figure on it roughly. Like another one for us is on our customer side. We have individual customers. We also, most of our business is B2B, and the payment terms on those two customers are very different. But we have a knob we can turn where we do business more with one set of customers versus the other. And that's like over time, we can change that knob based on our cash management needs.
Yeah, I wanna jump in on this. This is one thing that I think a lot of founders maybe don't spend enough time on. And a really easy example is in the software space, right? So you can charge customers monthly, you can charge customers annually. And usually when you charge customers annually, you give them a discount, right? Well, here you're making like a choice, right? You're basically assigning a cost of capital to that pre-purchase. And so you as an entrepreneur can actually then look at the cost of financing those receivables and see what's cheaper, right? And so what you might be able to do is you can say, okay, well, I'm going to sell 25% of my customers a 10% discount to prepay annually. Great. And then if I still need more cash, I can finance the rest at a 20% IRR. But now the blended cost of that financing is the weighted average of that quarter that you got at 10% and the 3/4 at 20, right? And so you brought down your cost of financing. And this is something that like I think people need to spend more time thinking about. Also, money paid later is worth less to you than money paid now. So if like net 30 and net 60 terms, they're not worth the same. And you should keep that in mind as you like manage your cash.
Amazing. You guys have already started the conversation I was hoping to steer us into next, which is like, how do you think about, okay, I heard one very tactical piece of advice, which is if you're considering making an operational change, getting a prepayment from a customer, offering them a slight discount for more like sooner payments. If you're thinking about changing net 30 to net 60, if you have that purchasing power, like those can be associated with a cost of capital, and you should measure it internally and think about that within your opportunity cost to other forms of financing it. Very powerful. I'm gonna kind of bring us into a bit of a almost debate style. I'm gonna have Jeremiah and Sam represent a bit more of the founders, operators in the room, and Dimitri and Will, you guys, the lenders here. And I really want us to get into like some of the decision making around like what thresholds, like how do you know when you're doing too much or when you start to get into danger zones? So maybe Sam and Jeremiah, coming to you first on to expand a little bit on if you are low on cash and you're balancing the various needs of suppliers, employees, investors, and you can't please everyone, how do you come up with frameworks for trade-offs? Like, how are you actively making those decisions and creating the internal steering committees to reconcile with the legal requirements of your lenders, what's being collateralized, and more?
That is a gigantic question. Jeremiah, if you have something off the top of your head, go ahead.
It sounds as though I need to like prioritize like which ones of my OpEx do I like go for first or not. I think first thing we'll do is like if we would definitely like go after all the receivable like all the sources of receivables and see if there's any quick one we can try and like pull forward, right? Like I feel like that's probably what we would do first. Then I think very, very quickly what's likely gonna happen is I think like any like and I don't want to sound like Samsung's a horrible place to work at, but like any discretionary comp will quickly get pushed to the next like like as far as possible and explain accordingly. Sometimes like I think some firms I've heard, and this is not from like Sunstone, but from, funny thing, I used to work at Shopify. So all the conversation here made me a little made some alarm bells go off. But I was gonna say, yeah, like back, you had some, I think discretionary comp is something that I've seen other folks pull. I've seen folks try to ask their employees if they'll take options instead of like cash comp. Like I've seen ways that that can happen too. And then I think after that, like it becomes like a really big focus on like any sort of discretionary expense. So you look at like all your different like SaaS products you're purchasing internally, and like the cost. I feel like once you've run through all those, which I consider are like really low hanging fruit, then you start really asking like the tough questions of, like do you pledge, do you have to like renegotiate like a credit term sheet? Do you pull venture debt, if possible, and all that? Sam?
Yeah, I think I'll take a. I think in my company, I think a lot of these cash management strategies, if we're talking frameworks for trading off with stakeholders, it does all become relational at some point. So this is all assuming that we've made a spreadsheet and we've analyzed the cost of capital for these strategies and the cost of implementing. There is this relational cost that always has to be included. If I'm going to ask for net 60 instead of net 30, I need to make sure that that supplier feels good about that. Or if I'm so desperate that I'm going to ask for it anyway, I have to actually measure what the relational cost is to do that. And so I think, I mean, yeah, so assuming we've done all the numbers and analyzed the returns on a given amount of effort in each one of these areas, then it falls back on relational cost. And so, and that is something that you can build over time and you should be building. We're talking a lot about like how when you have a lot of cash, it's the time to think about cash management and planning. Like that holds true for the relational aspect as well. Like if you're going to ask an employee to defer their comp or take equity instead of cash, like if they believe in the company and have been brought along on that journey, they are far more likely to do that. Same with any of these stakeholders. Someone mentioned something about taking advantage of press. Like, yeah, make sure you send all of your, make sure you send your big press hits to your vendors so they know they're supplying something exciting and big, that when you need them to do the net 60 thing, they'll be willing to do it because you've built this relationship with them. So I think that would be the piece I try to impart on this particular question, is to try to analyze the relational cost and to invest in those relationships early so that when you need to ask for that favor, it's there.
That is also both of your businesses are doing very well. So thank you for hypothetically tackling a really tough question, which is like, what would I do, how and when, if it were getting dicey, right? So I appreciate you going there with us. And even just like between the lines of what you guys described is very tactical for the folks in this room, of like, you're having meetings where you pull together the entire spreadsheets of all the options on the table, and you're making not only quantitative assessments, but also the qualitative judgment calls along the way, and thinking about how to do that before you're in that position. I want to, Will, Dimitri, how do companies stay liquid without over borrowing? And what are the thresholds where they get too far levered? And how might they clock in on that in the early signs? And Jeremiah, of course, Jeremiah and Sam, if you banter on this, please feel welcome.
Well, you want to go first?
You go for it, all yours.
I go first. Look, I think generally the question depends on the debt you are raising. Can you pay it off? Like it's often that simple, right? And that will boil down to a lot of different factors, right? So I think the place where people often get into trouble is venture debt. And maybe Will can comment on this from the perspective of HSBC, but oftentimes when we hear VCs talk trash about debt, it's because of bad experiences with venture debt where people drew their line, not realizing that or maybe knowing that they can't pay it back, right? And that is partially a challenge that is inherent to the product of venture debt, because when you raise venture debt, what you're doing is you're borrowing against your next raise. And in an uncertain fundraising environment, your next raise is not that certain. And that's a place where you have to be really careful. I think beyond that, anytime you take on credit, you have to understand, how will I service this capital? And so a good, like even in our case, right, when we lend against a contract, let's say you have a contract with Walmart to sell them your stuff, right? And we're giving you 90% of the contract value with some interest associated with that loan, right? You need to do your math to understand, okay, well, am I paying that interest out of my cash? So basically, are my VCs paying that interest? Am I getting it out of margin on a different contract? Does that support the rest of my business? And that's the math you have to do every time you take on credit, right? Anytime you take on any capital, you have to understand the associated costs with it. And so I think that oftentimes people are like, oh, well, this ratio is still good. Like my debt service coverage ratio, or my debt to equity ratio, or whatever. Like those ratios are helpful for public market analysts or CFOs of very large companies where they're trying to do quick analysis and understanding of the position of the business. But they're not necessarily helpful to you in operating day to day. And what you should really make sure is like, can I pay this loan off? And does my cash cycle within the business support the repayment of that loan on the time that my lender wants it, right? So I think sometimes people are like, oh yeah, we'll pay it off eventually. But if you're not paying it on the amortization schedule that you have, or the loan is, some loans are structured flexibly, where it's like they get paid when you get paid and the interest just accrues, and that's fine, like our government advance. But other loans, like you have a schedule that you are supposed to hit. And if all of a sudden your cash kind of model shifts by a little bit and you're going to miss one of those payments and you enter default or breach territory, it can get really ugly. And so you need to be prepared for that. And I think to Sam's point, like there's a big difference with coming to your lender the day before a payment is due and being like, hey, we're not going to make the payment tomorrow, and coming to them 2 months before it's due and being like, hey, I think we're going to miss this next payment. Can we modify our loan? Because I mean, unless they're really predatory, 9 out of 10 lenders will happily modify their loan and get more interest out of you if they need to defer a payment.
Yeah, I really support that view. And I think when things have been overstretched or challenges, the earlier conversation, the better. The banker who needs to go to the credit committee and explain what's happened, difficult to do that if it's last notice. So it was something that was mentioned earlier on trust and the brand you build and the relationships with your lenders. Super important. I think maybe Dimitri, you said, like for startups, obviously debt is the best use of finance when you've got predictable cash flow, and your equity is for the unpredictable. So make sure when you're looking at the debt you're taking on, what's it for? A few quite practical things. We all can't, unfortunately, come up with a new idea, get pre-funding on Kickstarter 60 days or 6 months before we launch our product. But have you truly mapped your full cash flow cycle? The day you need to pay for the good or the hardware or the engineering resource you're bringing in, right the way through until you get paid. Have you mapped that through? Is that in your budgets? And have you had those budgets reviewed by an auditor or a banker just to kind of get a second sense of it? Sticking to the sort of debate theme, 2 things I've seen work really, really well, and they've been quite fun. I've seen some companies do a war game scenario. They'll take half a day out, and the leadership team pretend they're running 2 or 3 of their main competitors. And they'll effectively say, if I was running X competitor, and some of you might be doing things that have never been done before, but there's probably a competitor out there in some way. If our competitor did this and launched this product at this price point, what would that do to our business and what would be the impact? And then you spend the other half a day defending against the strategy that you've just come up with. Some say don't look at competitors. I think it's really important. There's some things you can control and there's some things you can't control. And are you clear on where the 2 buckets sit and how you're spending your time? And then the other, I heard this last week, there's a business we work with and they have effectively known skeptics. So they'll do an hour as like a board meeting. And it will be, I think we should take on this new line of venture debt because we want to fund this new project. And within the team, you designate someone who is the skeptic, who says, okay, I like that, but what happens if there's a new tariff tomorrow? What happens if there's a government shutdown? What happens if something happens out of our control? And you almost challenge that next level of thinking. Have I mapped through every eventuality that may inadvertently cause my business and my employees and project to struggle? So bit of fun if some want to take that away and do it with some of the teams and the advisors you have around you, but it could be quite an innovative way of just thinking differently.
Oh man, I want to do war games with Will. That sounds productive.
I have a pirate name, so be very careful. Will Turner is the famous pirate. I think I might have you here.
Heard.
I just want to echo something about the war game process, which I think I think it's very difficult for startups to enter war game mentality because like the war game mentality is inherently different from the cap raise mentality, right? And so like when you suddenly like, especially right after a cap raise, when everyone's like bubbly, when you want to like pull that back and like do like a worst case scenario sensitivity analysis, I think it's like you can't, it's like really difficult to do that. And so like, I actually think that's a very good, it's a very good process. I want to say that like if you think about where we were when we raised some of our money and where we are today, right? Like we raised some of our money in 2023. Since then, like so the risk-free rate went from 0 to 5, and then a anti-climate administration got elected, right? And so like I was gonna say these are things that you'll never war game, right? So, and like probably no one like thought of, but I was gonna say like I think which is maybe the most easy thing you can do when you're like a young company is like build some buffer. Just make sure you have some buffer. Make sure you have like realistic worst case scenarios, and like always have which also like comes back to like, do you really want to draw that entire venture deadline? Right? What are you using for, right? Like what's like should you do it or not? Right? Do you if like do you have buffer to pay it back if like something happens, right? And so I think relying on like future revenue has always been kind of a challenge. Like especially if like, if relying on growth in a way has always been like has killed many a company.
Yeah. Can we talk about the actual threshold there? Like, is 5% enough buffer? Is 10, 25? Like, where do you kind of draw that line for the kind of rainy day? I think we all know our own personal finances hold 1 to 6 months of cash cushion in something liquid, but like, is the same true for the business? Is it a monthly runway to give yourself the time to do more war games? Like, what's the right threshold?
It's a good question. I feel like I feel like I think of it as like runway sensitivity, right? Like I like take our revenue and we like shock it and we see like in what situation, what kind of runway do we have, and I think like in if your worst case scenario, I was thinking if your worst case scenario is already like approaching 3 months of runway, you might effectively be like you might effectively be dead, right? Like you'll come, it might be like a year away from that, but like if like in the worst case scenario you suddenly hit 3 month runway, you can't raise in that situation, you're dead, right? So I think like I think you have to have, like for me, I think about it as like once you're approaching like 9 month runway, that's when like you really need to be very aggressive in thinking about your worst case situation.
Yeah, and I think I would add that this is where optionality matters a lot, right? So making sure you understand all of the tools available to you to extend your runway. What is the priority of those tools? What is the cost of those tools? I think a lot of folks are like, oh, well, I'll just raise a bridge for my existing investors. And if you think that that will, and like, look, we're actually talking about doing like a whole session on bridges maybe next month, so stay tuned. But there's there's a lot of incentive for those investors to get as much allocation as they possibly can get in a bridge financing. And even if they're impact investors, even if they're philanthropies, and like all of those people who you think will do you justice as an entrepreneur, they're capitalists. That's not where their incentives lie. And that doesn't make them bad people. This is the world you operate in, and you just need to be prepared for that. And so, doing a convertible loan, like a convertible note on a super down valuation with like heavy, with a big discount to your next raise, uh, in your head, you might be thinking, oh, I'll just do a convertible note, it'll be fine. But actually, maybe taking on like a working capital loan today, 10 months ago, would have been way better for you, even though the cost might be higher. I think I want to respond to this question from Paul about like the way venture debt versus a bank. So, one, most of the venture debt in the market, well, you can correct me if I'm wrong, but is from banks, right? So like SVB.
Yeah, probably by quantum. There are some
Yeah.
non-banks, but yeah, you're right.
Yeah. So there are both non-bank and, there's like Hercules, there's all these other big venture debt players. I also think it's important to remember that just because you're a startup and you're getting a loan doesn't make it venture debt. Like there's lots of different debt instruments available to startups, including us. We're not venture debt. But I think the generally my experience is that private credit is more flexible than bank credit when modifications are required. Generally, also your performance on the loan to date will dictate how much flexibility the lender has around modifications. And also your next, the reasons for those modifications will also drive whether or not they modify, right? So I'll give you an example, right? If you're like, hey, we're going to miss a payment, it's one payment, not a big deal, we're staying solvent, blah, 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 it's just like a cash problem, generally folks will be fine. But if you're like, hey, not only are we going to miss payments, but we're actually uncertain if we can settle the full loan because of XYZ parameters, different folks will react to that differently, and their own internal credit controls may not allow them to make modifications, right? So we've seen, I would say that like in our experience watching companies navigate modifications with banks for venture debt is oftentimes there's just like no room for flexibility because of the controls that are in place in those specific circumstances. But to Sam's point, like this is a relationship game. And the more you invest in that relationship, the more you invest in communicating, the more you spend time being like, hey, we're a good counterparty, the more flexibility they will have, even within those kind of like the archetypes of lenders. I don't know. Will, do you agree or different experience? I mean, you've seen way more of these at the bank level than I have.
Yeah, I have. We as a bank have lent over $1 billion here in the US. We've just done a new $1 billion fund in India. So there's definitely capacity on the bank side to back companies and put it through. A separate session we would help others, and there's some great guides out there about what to look for as you're negotiating your venture debt line, the concessions you're making, be it the warrants, be it the cash controls, everything else. So I think it's good guidance. I think, yeah, banks, but also have a look at some of the non-banks as well, just because there could be different appetites. Some know different subsectors better than others. We've got a tech, climate tech, healthcare business. We're particularly strong there. Others might be really strong in a subsector that you on the call are running through and know your industry and your market a little better. And perhaps maybe then you can get more favorable terms either on a pricing or a quantum or a structure.
Super helpful. I think one of the key takeaways is manage the relationship, have those conversations about flexibility early on. But also I think, you see with some larger facilities and lines of credits, you see the meaties of the world who trip up covenants and thought they had flexibility from their bank, and their bank kind of sweeps cash to take control of what they could. And I think generally speaking, also understanding the nature and the financial position of your bank, like their macro and their incentives, or your lender in general, because it can have an impact. It feels a little bit like black swan-y, but that's what we all said about SVB pre-collapse as well. So it does happen, and understanding their exposure can lend some empathy to where they may or may not be willing to give you flexibility, not just now, but in the future. Hard to do until you're a much bigger size, but worth highlighting. Sam, Jeremiah, any tactical tips on ways that you have successfully renegotiated either debt relationships or general management of receivables? Like, have you ever successfully negotiated a customer prepayment or smoothing out milestone-based billing in any way? What tactics in negotiations worked well for you, if any?
Yeah, I guess on the renegotiating terms with a vendor or customer, yeah, we've done plenty of that. I think general advice is what I said before: invest early and often in the relationship, and then when you go to make the ask, just be very clear with what you need, why you need it, and the likely road ahead from here. We want to continue to buy lots and lots of widgets from you in the future, and this is what we think this change of terms will do for us, and what can we give to you in exchange for that, as something that might be easy for me to give might make a big difference to them.
Heard.
Yeah.
Dimitri agrees vehemently.
Yeah, I think that last bit is really important. I think people often forget that they have lots of tools in their tool belt around what they can do for that other party. And it could be just as simple as like doing a case study on their website about your partnership. It could be marketing them as a partner. It could be referring them deals. Like we, for example, we work with a tax firm as our CPA, but then we also often refer them to our CFO clients, and like they then we don't have like a referral relationship. They don't like pay us commission or anything, but periodically they'll be like, oh yeah, we'll do this for you just for kicks. Cause like, you don't have to pay us for this because you referred us 3 more clients. And so I think like those types of things can give you a lot of leverage.
And I want to just add that, like, admittedly, you know, as like companies and startups think of like growth and everything, I think sometimes like managing the relationship with your deposit bank is not like number one, two, or three on your like list of priorities. But like I do think that but always kind of remember that if you have to go to them, you like think of it from like their perspective a little bit, right? Like it's all fine and dandy to say like, hey, I would like you to extend and modify our venture debt term loan, but the moment they ask you like, we want to see like your financials going forward, and if you like don't have that ready, then it becomes like a weird discussion, right? Like because then they don't really know what to trust or like who to believe. And so I was gonna say that, you know, sometimes like as much as like yeah, I really Sam's absolutely right in terms of like relationship building, managing those relationships. But also like I think like sometimes, especially when things are like if things are going south, right, you have to like think of their perspective and how to like communicate, help them kind of communicate your story back the other way. And I think for us, like we've negotiated certain terms before that, you know, allow us to get paid like slightly sooner or like earlier in between, like, you know, when, you know, if you think about it, our loans only fund like in 6 months, right? But there are ways to get like paid in between that are like negotiated between us and like specific counterparties that can help us, you know, that can help us manage cash flow and make it like kind of less lumpy over time.
I love that. And Jeremiah, try and get out as much as I can, but trust me, the bankers want to get out of the offices. They want to see what you're building, walk around. We've done a couple of videos. This links to your point, Dimitri. We've got 2 customers that were happy to do a video that's on HSBC site. One is Lightship. They're making the first EV holiday sort of wagon and traveler, great business. And then Mill, they do a compostable bin that you'd have at home. So we've gone, the team have gone, both the relationship manager and the team. They're curious. They want to learn. They want to understand the roadmap. If we're on site and we can see something's a prototype and it's going to take 18 months to sell the first product, and then we see a business case that says exactly that, it just reaffirms what we're hearing. And then if you see some slippage, it's because this component part that was coming from Argentina or China is held up. Okay, we can understand it, we can visualize it. So yes to getting the banks out, show them around, be proud. We want to hear, we want to learn and understand it. And then if you can get any extra leverage from videos and stuff like we've put on our website to try and bring this to life for people, 2 very smart suggestions.
I think that really resonates with Sam's earlier comments of like, send your successful press, send your LinkedIn posts to your vendors, like bring people along. And that takes just a couple extra emails and forwards and site visits. And I think it's a great way to wrap this session because cash is like this kind of funny number that sits in the bank or maybe multiple banking relationships. It's like a little bit intangible, and yet in some ways, cash is king in these businesses. We're going to end with a lightning round. We're going to go to Jeremiah, Sam, Will, and then Dimitri. If you could give founders one piece of advice over in the overall topic of everything that we've touched on today for managing their cash and working capital, what would it be?
Be careful of who you hire.
Yep.
Wow, that's a good one. Look, I would say don't forget to look internally when you're considering cash management. Don't just look externally, look at what you can do.
Love it. Will?
Pursue the greatest value for your business. And what I mean by that is some might chase a high yield, a couple of basis points in the short term, but if you haven't got the right provider who's there to help you through the good and the bad, you might look back and regret a short-sighted decision. So know your value and go and demand it from your partners.
Read the fine print. This is especially true for loan agreements, but also across everything like this. You know, you might get a treasury account at some bank, and then you discover later that you can only make 2 transfers out of it a month. In which case, might not be as useful to you if you're trying to do treasury management on a daily or weekly basis.
Amazing.
Can I have two? Talk to a
Yeah.
lot of people. Like reference the venture debt question. How do you know how much is too much? Talk to someone for whom it's gone poorly. That's a really good way.
And don't just ask your VCs for advice. They're not the right people to ask for this kind of advice.
As a recovering VC, I have to agree with said sentiment. Well, on that note, it's such a privilege to have all of you here today. Will, Sam, Jeremiah, Dimitri, thank you so much. And thanks everyone for joining. We'll circulate the notes next week along with the video recording. And we are always, Dimitri and I's inbox is always open. If there are specific topics you want to hear about, if you want to follow up with the speakers and their various products today, we can put you in touch. And we are super keen to hear what you want to learn about in future sessions.
Awesome. Thanks, everyone.
Good luck, everybody. Thank you.
Thank
Take
you.
care. Bye.